Hello and welcome to IBA's new series of weekly webinars entitled What Are My Aviation Assets Worth?, where we look at asset values and lease rates in the current crisis. My name is Phil Seymour, Company President at IBA. Thank you for joining us today. I'm pleased to welcome our experienced panel. I'm joined by Stuart Hatcher, IBA's COO, Mike Yeomans, Head of Valuations, and David Archer, Senior Analyst. The panel are going to be sharing our approach to valuations. We're often asked, should appraisers lead the market? There's a lack of data points. So should we be opining on something that we don't actually have evidence for? On the other hand, we've been in business for over 30 years, so we can look back at previous downturns. Are they relevant? Where does this fit in with the current crisis? As a reminder, we designed these sessions to consist of around 30 minutes of opinion and analysis and 30 minutes to address your questions. Thank you to those who've submitted questions already. We'll be taking more questions during the webinar, so please do ping them over via the questions link on your control panel, and we'll look to address them where we can. Looking at the numbers, we've got a lot of people listening, some of whom may not be familiar with who we are and what we do. So before we start, let me introduce IBA very briefly. We strive to maximise opportunities and minimise risk across aviation assets, and we do this through our advisory services, our aircraft and engine valuations, practical asset management and technical services, as well as providing intelligence through our platform, IBA IQ. We are, of course, Appraiser of the Year 2020. I mean, what a year to actually be Appraiser of the Year. I think it's going to be one of those things that we all look back in time and wonder whether we did manage to predict things correctly. In terms of the ISTAT appraisers, you can see on this slide, we have 5 seniors. I'm a senior appraiser fellow, given my chairmanship of the program for 6 years. And we do have several candidates looking to become ISTAT appraisers in the coming years. I think without further ado, I'd like to hand over to the next slide, and let's get cracking with this detailed content today.
Thanks, Phil. I just wanted to start by discussing some of the commonly used value definitions. IBA has identified how some elements of the commonly used ISTAT definitions do not comfortably align with the market conditions that we're seeing today under COVID-19. If you look at the table from left to right, you can see 3 of the common definitions, or the most commonly used: base value and market value. On the right, we've included a soft value definition. Now, that is something that has been developed by IBA and is not something that's specifically defined under ISTAT. If you look in the table, the color codes there denote whether we feel that particular assumption holds true in the current market environment. Now, you can see that neither base nor market value really align with what we're seeing under COVID in terms of the assumed lack of pressure in the transaction. Nor do we see that the current market is unrestricted. A lot of the transactions that we're seeing going on in the market, a lot of the sale leasebacks, there is a pressure on the part of the airline to engage in those transactions. You can see that distress value does align with current conditions in that the majority of the transactions we're seeing are pressured. But even the unrestricted market element of the distress value definition under ISTAT doesn't quite align. Although we've not included our full definition of soft value in the slide here, you can see that on the IBA website. And in the definition, we do talk about things like an imbalance of supply and demand favoring supply, a slowdown in global economic activity, slowdown in global traffic. We also refer to high levels of storage, and all of these things are evident in the current sort of market setting. So if you are thinking about where values of commercial aviation assets are sort of transitioning to, descending to, soft values are a good reference point. Can we go to the next slide, please? Okay, so when we consider a specific transaction involving an aviation asset, or a specific appraisal exercise, we have to use an appropriate value definition. We discussed 4 of those on the previous slide. There are additional definitions such as lease encumbered value, where we're considering rental, maintenance, cash flows associated with the asset. There's also part out or salvage value, which is probably more appropriate for an end of life scenario. And there are others, ISTAT and non-ISTAT defined values. That's not an exhaustive list. So the correct value to consider and to use will be guided by the purpose of the appraisal and also the circumstances under which the value is required. So that's why it's very important to discuss the purpose of the appraisal with IBA to make sure that you're getting the right value, right definition for the task in hand. The scenario under which the appraisal would be conducted, you can see some examples at the bottom left of the screen there. An early lease return, for example, if you were trying to sell an aircraft with a lease, without a lease, sorry, it's a young aircraft, you might consider that as a distressed sale, or you might want to look at a release scenario, get an opinion what that aircraft might release for, and look at it from that perspective. An airline bankruptcy scenario, where an administrator is looking to liquidate and return to an investor for a quick sale. Of course, a base value or market value is not going to be appropriate in that circumstance. So that would clearly be, a more distressed scenario, and the value would have to be defined and applied accordingly. And now, if you were to look at an impairment test situation, we would be typically looking at fair value less cost of sale, which would be more of a typical market value scenario, obviously net of any remarketing or sales cost. Alternatively, we could be looking at a value in use, looking at the asset as part of a cash generating unit. And also, if you look at the last point there, if the purpose is to test a loan to value covenant, we might be looking at a market value adjusted for maintenance condition. But here, obviously, we're purely looking at the asset value and not its cash generating ability. So a set of different scenarios, and all of which require a different sort of viewpoint potentially. Then you have to look at the participants in the transaction as well, because that can have a bearing on the result of the appraisal and potentially what definition that we would have to use. We look at things like, does the owner have technical capabilities or resources, and how might that limit the options they have in disposing of the asset? And do they have a partnership with a company like IBA that could help them to manage the asset or to redeploy or remarket the asset? Is the party an airline, a lessor, a bank? That can make a difference in the trade as to how the transaction is perceived by a buyer, level of pressure, and also the approach that we might take in terms of the appraisal. For example, an impairment test, a value and use assessment is going to look different between a lessor and an airline. What's the liquidity position of the seller as well? Can the seller ride out the storm in a weaker market like we're in at the moment? Can they park the asset and store it and wait till the market improves, or is that not really an option? So if we go to the next slide, we've got a sort of illustrative example just to give an idea of a transaction that you might expect to happen, or trade an aircraft that you might expect to trade in the market at the moment. So the example we have here is a Boeing 777-300ER, a wide body passenger configured example, only around 1 year old, delivered sort of last June. But this isn't subject to a particular transaction. This is just an example that we're giving us some guidance. You can see on the top right data from our online database, IBA.IQ, shows you that it's owned by ANA, 4-class configuration, 212 seats. And now, depending on the transaction scenario, you could have a very different result in terms of the value. If you look at the bottom right of the screen, you can see where a value could lie under various definitions and situations. The base value and market value here, I must just draw attention that they assume half-life, but because the aircraft's only 1 year old, they do include a premium that the aircraft's not going to yet reach a full half-life condition. We've included the half-life market value pre-COVID, and you can already see that was dipping below base. So there was already some imbalance before the current scenario took hold. Now, as I've mentioned, a typical transaction at the moment we've seen with many of the traditionally stronger tier carriers is that they're entering into sale leaseback deals to raise capital. And the value of an aircraft under such a deal would typically be represented by a lease encumbered value. So for these sorts of transactions, we'd typically assume a 12-year lease for widebody aircraft like this with a full life return condition. You can see some of the assumptions there just to the left of the table. Before COVID, we'd seen similar sort of deals last year, some sort of around and higher than our market value. And you can see that represented by our pre-COVID LEV. We had seen lease rates softening in some of those deals, but pricing was still high, so lease rate factors were under pressure, as they were with most assets, narrow bodies and wide bodies. You can see that in the sort of 0.6s range there. However, what we would expect in the current environment with the reduced competition, featuring many more better capitalized lessors, much weaker airline positions, a lot more risk and uncertainty, lease rate factors had recovered, and despite an increase in the lease rate, you can see here in this example of the post-COVID LEV is lower, around sort of 10 to 12% in our example here. Now, obviously, a sale leaseback transaction would yield a different result to if the aircraft was sold without a lease. That could be considered a much more distressed transaction in the current conditions, and would likely yield a lower value. We have given an example of a part out. That's just illustrative. This is a young aircraft, 1 year old, so we wouldn't expect an aircraft this young to be parted out at the moment. You can see just an option that some operators that use this aircraft type have been looking to in the recent market conditions. That's an Air Canada aircraft that's had all of the seats stripped out to turn it into a freighter aircraft to transport medical supplies and to deal with the coronavirus. So I'm just going to pass you over now to Stuart, who's going to talk you through some changes in lease rates and historical performance there.
Thanks, Mike. Moving away from the sale leasebacks, I want to explore the potential impact we may see for market values, lease rates, and what the stress might look like for other assets. Starting with the failure chart, I'll show what the current failure chart looks like, which has jumped quite considerably this month alone, with the announcement of several airlines entering into administration. Now, many of you would have seen this chart, but for those that haven't, it displays the year-end position for number of airlines that have failed in orange, plus the number of aircraft in red in that fleet just prior to failure, and then the Brent pricing in green. The current year is displayed as of today to show the evolving situation, whilst the blue dot in the upper right shows the extrapolated number of aircraft involved should current trends persist. The inserted chart indicates the relative size of the fleets involved. So this current chart also includes some operators currently in administration, so not all failed. If these known ones in play don't recover, then we would have already passed the historical record for aircraft involved in failures, which had already happened last year in just the first 4 months of 2020. This chart has historically shown the correlation with oil price being a strong influencing factor in airline failures. However, we witnessed a divergence last year as currency and competitive tension began to play an increasing factor. So we started to see some business models fail outside of normal oil conditions. Now, 2020, of course, has witnessed the shock event that we've all been expecting. So, although not the nature of the shock, of course, and so we would expect a deviation from the norm as oil will have a little further negative effect on the outcome. So, based on pure extrapolation of the year so far, would put the year-end estimate to around 1,400 aircraft. But looking at the likely GDP impact, prolonged lockdown and a reticence to fly, that number will grow considerably as more airlines will fail to survive. Whilst in normal situations, we would expect some of this capacity to be soaked up, especially by local operators who tried to fill the void. And we saw that last year with Jet Airways and SpiceJet taking up a lot of that. All airlines will now be looking to remove capacity. Therefore, we don't expect to see much demand for those aircraft coming out in general terms, with potentially the added headache of surviving airlines wanting to shed even more of that capacity. While some of their excess capacity may be parted out, converted, or simply be too old and head to the desert, the majority will hit the trading market. With world GDP expected to drop by 3% and 6% in developed nations, and based on historical trends, we could see RPKs drop by more than 6.2%. That will equate to a drop in the world fleet of over 2,000 aircraft. The highest ever drop in RPK before was 2.9% negative, and the fleet continues to rise by a further 500 aircraft, but that was before airlines got their heads around capacity management to see where we are today. So if we go to the next slide. So this is a slide looking at the trading cloud. So relating to that, to where we have seen trading before, and there's lots of evidence out there to fall back on to make this judgment, we can make some estimates as to where values can go for the rest of 2020 and 2021. So in this week's webinar, if we take a view on just one of the most historically liquid aircraft, 737-800, there is a substantial trading cloud to draw upon to highlight areas where the effects of overcapacity in the trading market and had serious effects on market value. The trading cloud is agnostic to specific market cycles when presented in this way, but highlights how we set soft and distressed value versus age. Now, within this current cloud that we have here, there are around just over 1,600 points that fit this specific model, age, and range, covering all aspects of secondary trades only, and sale leasebacks. The top of the cloud highlights trading performed at the top of the market, whilst the lowest figures typically indicate distress situations where available or weaker market conditions, and they are the lowest observed trades. So if we move on to the next slide. So taking this one stage further and looking at three specific vintage 737-800s, and I appreciate this is a relatively busy slide, displaying the early build, mid build, and late build aircraft. We can see how prior events have impacted these over the past 20 years. With further experience drawn in from other narrow-body aircraft, such as the Classics and A320 family, we can ascertain our definition of soft and distress, which are statistically calculated from the trading cloud to capture deviations from an ordered base curve. Our base curves are all pre-COVID and have changed very little over the years, and highlight the underlying stability of the asset, but also the relative steepness associated with positions in the production cycle from entry into service until the production launch of the replacement technology. Now, this is considered to represent the last line effect and is seen in previous aviation recessions, usually amongst the most vulnerable groups, as older assets coupled with incoming technology sets a new pricing level. And we saw this quite graphically with the Classics in the late 2000s. Now, to reiterate, soft value follows the definition that Mike presented earlier. Whilst the stress can happen in any market condition, but limited to where the seller is motivated to sell quicker than normal, as usually as part of a disposal or a bankruptcy. Therefore, this purpose, we will assume market values will restabilize at around soft values, with those assets resulting from failures that may need to be placed quickly falling into the distressed value category. So starting with the one on the left, as we look to the oldest, much of the depreciation has essentially already occurred. If we follow down on that blue line, And this is traditionally where we would see a high relative deviation that we can see there in the box, but lower dollar value change. In this case, the level of soft value is not far from distress levels. The oldest assets tend to illustrate this behavior as they all underpin trading activity for that aircraft type. We therefore expect to see a drop of maybe around 4 million, which is a drop of 36%. But when you look at it from a point of view of, say, where the distress position is, it's very marginally different from that. And this aircraft takes it down to around $7 million, and which is a prime position for a conversion or a part out value. Now, moving to the middle one, to the mid-build 2008 version, and certainly one of the more common assets found in the releasing market, as the first leases have so far ended. These assets have shown great resilience to value volatility, and up to now have remained a strong favourite of airlines and lessors. In a soft market, we expect that many of these aircraft will return from lease despite low oil price and trigger a softener value of around 5.7 million, which is they're looking at around 25% difference based on that, with a further 2 million downshift towards distress conditions from the current market value position. And that's what we have seen in the past in other types of assets in previous times. Now, finally, moving up to the newest group, this aircraft is already considered to be on a fast depreciating profile, as it can be classed as a last of the line asset. In these situations, base, soft, and distress values move at a faster rate. Historically, it is this group where we have seen the highest effect due to distress and was highly visible for the late build 737 classic market in the late build up during the GFC. Values are underpinned by the older assets available in the market. However, we would also normally expect that a replacement aircraft was in full use by this time. Whilst we don't necessarily expect to see vast number of these aircraft be sent to the desert compared to competing variants, the absence of the MAX will help its fortune. So this is on a slightly more downward side. Soft value expectations are, much lower in relative terms, and looking at around 12%. But of course, what that relates to in monetary terms is around 5 million. But then when we look, say, at the distress, then it can get quite significant. And that is, of course, I wish to stress that this is only a guidance at this point. So moving on to the lease rates, if we go to the next chart. Lease rates are generally more dynamic and more agnostic to age profile than value. So where we can look at just the constant performance for a new 737-800 versus a 10-year-old example that is transitioning leases. Historically, we have displayed lease rates against a 5-year swap rate, which naturally influence the new leases. Now, this connection with older aircraft releasing is a little bit more tenuous, as market supply and demand of competing assets tend to have a stronger influence, although there is some connection that is evident. Now, looking at the newest first, once again, we can see a larger magnitude of change in stronger, weaker markets, which equates to a smaller relative shift, as clearly the new assets remain more attractive to the marketplace. A drop of 20% in lease rates from a base position would be expected for any young narrow body. However, lease rates have been weak for some time, so I believe this might be tempered a little bit more. So we might see a little bit less than that, and from the expectation of oversupply. Now, looking to the 10-year-old aircraft, we'll already be encountering lease ends anyway, and volatility has been relatively tight as MAX aircraft can't operate. That being said, a drop in 25% is expected, such that we would expect to see a $200,000 lease rental for a 10-year-old going down to $150,000. Now, when the market turns and failing airlines will force to an early return, those carriers who remain and need to reduce their capacity will enter into discussions with lessors on how to limit those damages. Now, those with leases with a lower break cost will be the first to go, I would expect, whilst a robust discussion may occur on the younger assets. Either way, more supply comes back into the market and lower rentals are negotiated. This differs from how new sale leasebacks will be structured. We have a definitive uptick. We see a definitive uptick in lease rate factors over just the past month. But again, we'll go into more detail with more examples next week. So with that, I will pass over to David to look at some engines.
Thank you, Stu. So obviously some of this leads back to the engine webinar I did with Phil last month. So anybody who hasn't tuned into that, I suggest you go back and have a listen. That goes into a bit more detail. But what I wanted to highlight here was just how we're looking at engine value performance, any areas of vulnerability, and again, some examples of historic downturns and how that's impacted values. So this chart on the left is to give an example of two relatively similar engines. We're looking here at the V25A1, which is a very early build standard for the A320ceo fleet, which was relatively young when it was replaced by the V2500A5. We're looking here at the V2527, which is a very common variant of that engine. So if we look at a couple of cases here, we look post 2001, so after the impact of 9/11 on the market. There's two factors really to look at here. There's the level of value downturn and the time taken to see a recovery. And that's really what we're looking at when we're discussing the vulnerability of these assets in these downturns. So despite being two fairly similar engines on the same kind of aircraft, the downturn, if we look at the A5 example here, we're looking at about 7 to 8% at its peak from having a fairly high market value prior to this to the downturn, to those values dropping below that base value line. The base value line here, sorry, is in red, and the market value in blue. If we look at the A1, to counteract that, we're looking more to 12, perhaps up to 14% value drop. So that's kind of a direct correlation there between two levels of a similar engine, but different levels of vulnerability. And the same trend can be seen in the period of recovery as well. So if we look at the A5, somewhere in the region of 5 years before those market values came back to that base value curve, and from there obviously went well beyond. Whereas for the A1, more towards 7, maybe even 8 years before that recovery, and even then not seeing those same levels of peak above that base value, sorry. We can then look again to the 2008 global financial crisis, and clearly you can see here the difference in the resilience of those two assets. Now the A1 at this point in time was quite a bit more of a mature fleet and a much smaller population, which makes it even more vulnerable in comparison. But the A5, you can really see a lot of resilience there. You do see, again, those dips of market value below base, perhaps in a similar range. So that's 7, 8, maybe towards 10% towards the end of that downturn before, again, a recovery. So this top right section of the slide here, I just want to give a fairly high level, fairly broad definition of how we're breaking down these groupings of vulnerability and how we're seeing certain assets in comparison to this. So this low level of vulnerability, these would reflect the engines on the A320neo, so the LEAP 1A and the GTF. The 737 MAX, obviously there's conversations around that, but the LEAP 1B we still see as a very similar low vulnerability asset. We can move from there to fairly low, so at a similar stage as the V25 was, perhaps after 2001 or definitely for 2008. So a more mature asset. We're looking at later gen narrowbody engines. So I've put here the 5B, the 7B, and the V25. These engines represent the 737NG and the A320ceo. So these we'd expect to see good resilience, but more of a softening in value, a slower recovery than the latest generation of engines. I've also noted here the CF34s. These would probably fall more between the fairly low and that medium range as well. They performed well recently, and I think there's a good market behind those engines. That should help it see some resilience. The medium, this is where we're going more towards assets which are still in popular use, but are towards the end of their operating life or starting to see a more mature stage. Obviously, we've mentioned before that wide bodies tend to be more susceptible in these periods. So when I say recent mature wide body engines, I'm talking about, as an example, the A330 fleet. Fairly young average fleet age, but you have some older examples there, along with later production peaks. We would expect to see more of a softening there in terms of values and the recovery. And mature narrowbody engines, this doesn't just reflect, like the CFM56-3, which is probably more towards that high risk, high vulnerability, but also early build, so the 5B/P, the base 7B, and the V25 non-select engines. They're at that point, as you can see on that chart on the left, with the base value curve beginning to pass that peak of maturity and being a bit more vulnerable to softening, especially compared to the later generations. The 7B Evolution, V25 Select, or the 5B PIP. These have only just very recently kind of come to the end of their main production life, with a few kind of spares ongoing otherwise. And then finally, the high risk. Obviously here we're looking at the larger wide bodies, particularly mature examples. I've highlighted here some cases which I don't think will be a major surprise to anybody. So the A380, the A340, 747, NG80, the power plants on those, we expect to see pretty significant softening in value, particularly with the the increase in retirements we're seeing on those. And finally, the chart on the bottom right, there's more for you to look into yourself, but it's just to highlight how we're looking at the value spread in terms of half-life value at the top end of that chart down to the soft value and where that spread is. Now, I've tried to give a fairly broad range of engines here. We've got the LEAP 1A on the latest generation of narrowbody engines down to the 7B26, which is obviously the base model of the 7B, so the earliest on the 737NG. But you'll also notice that you'll see a larger spread on the likes of the GE90 and the GEnx. Now, obviously the difficulty there is the percentage for, if we were to compare the GEnx to say the V25 Select 1 or the 5B/3, will be somewhat similar, but the dollar value is much larger, hence why there's a larger spread there. And the GE90, we'd already softened our values prior to this downturn, and there are indications that maybe we may see some positivity in the longer term future for that, especially with the A380 difficulties. But that spread there is just indicative of where we think the soft value may go down to. And then I'll pass back to Stu now.
Thanks, David. So looking at my final slide before I hand back to Mike, briefly covers those we feel most vulnerable versus those that may be less affected. It is important to note that no aircraft will be able to escape completely unscathed, but there will be a substantial difference in how market demand will impact values and lease rates. We will go into these in more detail in future weeks, but this gives you a view as to what we might expect to see. Now, clearly, large wide bodies will be affected both from capacity point and from the barrier to open up longer range routes. However, we may be pockets of hope whereby 777X replacements are deferred and 777-300ERs are kept a little bit longer than expected. So it's not all necessarily doom and gloom. Clearly, last of the line assets will be high on the list, as we've already previously discussed. And then another one, of course, on here is high capacity family members on typical routes. Now, that may be a confusing one, but what this points to is a low oiled, low demand market often sees them move away from the larger family members towards the smaller ones. So we've seen that before with the resurgence of demand for 737-700s, A319s, in place of 900ERs or A321s. Now, we're not specifically talking about 321neos here, which are looking at longer range routes that may be able to impact on wide bodies. This is more about the typical 321ceos. But similarly, we've seen the same thing on 330-200s versus 300s and so on and so forth. Turboprops don't do particularly well in low oil environments anyway, and we have seen a lack of demand in some of those types. 737 MAX still remains a big problem, and we're still trying to ascertain what that may be. And of course, any aircraft that can be returned at low penalty probably will against those where large penalties are likely. So this is more transaction specific rather than a specific asset type. Scope vulnerable assets where there is a requirement to maintain a certain fleet size, of course, is an important thing to consider. And finally, in this list, large freighters. Now, of course, we've seen a real resurgence of freight in the last month. Once the belly freight has been lost. But once we see that freed up, we are on the edge of a global recession. Once freedom is restored, the normal trappings of a recession should start to take hold. GDP will, by definition, be down, and freight demand is part of that. So we expect to see some of the larger assets being quite affected here. I don't specifically include 767s in this category as well. So there is a difference between the different categories of freight. I won't go into the details of the lighter side. I'll pass back over to Mike, but you can see there in terms of the areas where we would expect to see lower vulnerabilities.
Thanks, Stuart. So I just wanted to finish up just by summarising IBA's approach to future value changes and what happens next. So we're in a constant process of reviewing values. As Steve mentioned, we're looking at aircrafts values on an aircraft by aircraft basis. Part of how we review that is through our value forum, which is a gathering of IBA's ISTAT certified appraisers, which you saw on an earlier slide there, along with other members of our appraisal team, members of our senior leadership team and other departments within IBA. So we're monitoring the market. We're having regular calls with our clients and other industry stakeholders, gathering data, gathering opinions on what's happening in the market, and using that and reviewing that in our forums to guide our value decisions. In terms of base values, we're not planning or expecting to have to make any specific COVID-related adjustments to base value. In our view, it should follow a longer-term trend, which is an inherent aspect of the definition. So not expecting really to be making changes to base value. Where we will be making adjustments, however, is to market values. We're expecting changes to start flowing through over the coming weeks. We've obviously mentioned issues around data that aligns with market value definitions, and particularly data points that would align with the ISTAT definition. But we are looking at other market indicators, as Stu's gone into, and David in some detail there, about the historical precedents, what we've seen in the past, and applying that to what we're seeing now. Any airline failures resulting in sort of large influx of aircraft into the market, that will obviously guide our views on value performance of the assets affected. Looking at other areas such as exit strategies, operators divesting large numbers of particular aircraft types or sending them to part out, and obviously into long-term storage. So building a picture using all of those factors into how we'll be adjusting our market values. That will obviously flow into our online system, our IBA.IQ platform. So we'll be updating values there, and we'll make everyone alert to those changes through these regular webinars and other content that we put out on our website and on social media. And we are in the process of reviewing our values and lease rate publications in terms of the approach that we'll take there, whether or not there's a possibility of issuing a third set of publications. That's something that's under review at the moment. So we'll make sure to communicate any changes on that point through similar channels as well. So I'd now like to just hand you over back to Phil, who is going to field some of the questions.
Yeah, thanks, Mike, and thanks everybody for your questions. We've had almost 40 questions, and we've got about 20 minutes left. So many of the questions do relate to topics which are slightly outside of the scope of this webinar. We will get back to you all individually, but I really want to keep this into some of the sort of valuation side of things, bearing in mind, as I say, we are holding a series of webinars. The next one is next Thursday, the 7th of May, where we're going to do a deeper dive into some of the specific areas we're looking at, such as numbers of retirements, what that will mean, how, if by then we've seen more information on lease rates and some of the sale leasebacks that have happened recently. But I will, one of the questions we had raised was, it covers a lot of areas, but it gives you a sense of what's going on. You know, with potentially a lot of older aircraft being parked, we also have a very low fuel price at the moment. The push has tended to be towards more fuel efficient aircraft, such as the new technology. So in terms of, you know, how do we see a balance between the potential that there'll be older aircraft operated longer versus the sustainability agenda? I mean, is it right? I mean, I suppose I'll ask Stu, do we tend to see older aircraft being the first ones to be retired, don't we, rather than kept going? What's your view on that?
Yeah, in all previous situations, we've seen the older ones fall by the wayside. Now, I think that clearly interest rates being where they are, oil being where they are, you've got two very opposing factors there that will drive one versus the other, and we also have the environmental debates. But oil's never has seen this level of percentage drop before, so operating cost is not really the major play here. But we've already had the last 5 or 6 years where we've had a low oil price, and we've seen constant extension after extension after extension. And I think there are two deals to be had here. I think in one side, lessors are willing to have those extension conversations for much longer. Clearly, they would want that, and some airlines may do. But also, airlines are also wanting to look for homes for those newer aircraft that they have maybe not that much choice about taking. So certainly, we've got a number of sale-leasebacks out there that may be able to get them through. So certainly, when you're looking at those who have a liquidity to be able to spend on new aircraft, there could be some very good deals there with the rising lease rate factors. So I think that there's going to be a competition between those types of trades. It's not clear cut. From one side, you will see airlines who will want to keep the older aircraft flying because it's cheap to do so, keeps their costs down. But at the same time, if there are deals to be had, there are also ways of raising capital at the same time. So I think it's a real neck and neck on that one.
Okay, thanks, Stu. Also, I'll stick with you while I've got you, if that's okay. In the sense of you refer to the 737-800 as showing some of the lease rate issues that had happened in the past there with downturns. I mean, is it fair to say the A320 CEO of a similar vintage follows the same sort of line with what happened in the past and what could happen now?
I think a little potentially yes, but I think there is a potential difference too, in that we have an older vintage of A320 that gradually is being moved out, so we will see a lot of those shift outwards. But the other thing is, of course, the A320neo is sitting above that, whereas the whole MAX problem has the added benefit to the 800 that it can keep it flying for much longer. The replacement is less clear cut in terms of its future, and so the estimates that I put into the webinar do show a situation where we've seen previous examples, but not the MAX issue is a totally different and unique one. So I would expect that the 800 could be affected softer whilst the MAX is in that situation, but we were expecting to see that the MAX to gather pace in terms of getting into the air before the end of the year. So we would expect that eventually next year and the year after there will have the similar problems we'll have with the 320, but normal 320 CEOs we will expect to see being a little bit more impacted.
Okay, thanks. Yeah, I mean, we've seen in the last couple of years, we've seen some of the older 737-800s, which we thought may be candidates for passenger to freighter conversions. There's really been quite a lot of competition with the part out guys who were also bidding for those sorts of aircraft. So, I mean, are we in a situation where we're expecting so many older NGs to be available that will mean that there'll be more part outs, or will the part out market get flooded as well? I mean, I don't know if Stu or Mike want to field that one.
Yeah, I can step in and give some thoughts there, Phil. I think certainly some of those pressures that have led to lower numbers of conversions are certainly going to be alleviated in this environment. You've had very high pricing for part outs. Engine values have remained strong, as the value of other sort of used serviceable material, and that's kind of pressured where once you add that cost of that feedstock still competing with aircraft, with buyers or operators that would lease aircraft into continued passenger use, once you add in that cost of conversion, it has pushed those costs up into the sort of 20 millions range, and lease rates have been quite high there as a result on some of those early aircraft that were converted. But we've seen already some sort of older aircraft coming out of American. Had planned to divest of those aircraft, but obviously given the conditions is doing that earlier, so there could be potential for some aircraft to be converted out of American, and we'd expect to see that some other carriers as they rethink their fleet plans over the coming years. So yeah, there certainly will be opportunities to convert aircraft in larger numbers over the next few years, I think.
Yeah, and I should add that we are going to be doing a specific freighter webinar in the coming weeks. We'll let you know as soon as that is going to be scheduled in. Obviously, we're seeing an uptick in some of the freighter use because what would normally go in, I suppose, the belly of passenger aircraft, that option isn't available. I just wonder how long term that will be sustainable. But I've got a couple of questions on engines, and David, I'm going to direct these to you. It's really related to the A380s, and that because we're seeing the potential for those to A380s being parked up, and will they actually enter into service again? What does that mean for the Trent engines on those aircraft? And likewise, I suppose some concern over the softness in the 777 market and the GE90. Have you got something to add to those?
Sure. Yeah. For the A380, obviously we've looked at the GPs and the Trent 900s as being fairly soft markets for some time now, but obviously the events since COVID-19 have obviously accelerated that. We have made moves to adjust our values to reflect that, and really the reasoning behind that is the economic life that we originally assumed in those assets just isn't there. So to achieve that, we basically accelerated the profile. We're seeing a steeper decline in those values. So for the A380, yes, definitely we're seeing a softening there, but really from a transaction point, very hard to gain a great amount of visibility there, unfortunately. For the GE90s, a fairly similar story. We were seeing a softening recently, and we did make the move to bring market below base for the first time in some time. Now, long term, I think there is a good opportunity for the 777 to turn that around. I think, particularly with the A380 going kind of out of popularity or out of use for some of those top tier operators, there is some space for that 777-300ER still, and with 777X orders, I mean, still not really performing that great. I think there is some room there for improvement. I know there are concerns around the control of the OEM aftermarket, and really that's across all OEMs in the widebody sector, and that can, there was a question around that can impact residual values, and there are the liquidity of the asset at end of life. But for now, we're sticking to for the GE90, we're sticking to our base value curves as they were. We're not making any changes there. I hope that answers the question.
Okay, thanks, David. I think as far as just to sort of couch this in terms of why we're doing these series of webinars, I think we were a little bit concerned that we'd seen some numbers being put out in the press where there were absolute numbers given on particular age of aircraft. I think we saw something like 5-year-old 777 would drop in value by 23%, and I think it got us wondering about where the evidence was for that, and how you can be so specific. So that was really couching this presentation in terms of explaining quite carefully the different valuation scenarios. But a lot of the questions we're getting are where do we see values going on perhaps the E-jets, the 175s through 190 and 195s. Is there going to be a trend towards sort of smaller capacity aircraft where we'll see some benefit in those regional jets of what I would call the first generation Embraer jets, where we had potentially high engine costs and high fuel costs, but with the lower fuel price, will we see a resurgence? And likewise, turboprops, will they be, because they're more flexible, there's less cost of reconfiguration, will we see a move towards enhanced values in that sector? I don't know, Michael or Stu, if you got any views on that. Again, I know we're going to be covering some of these in some future webinars, but do you see a general trend there, or is it going to be specific to each operator and lessor to negotiate those rates between them?
Yeah, and it's Stu here, and I think that it will vary, because I think that you're looking at lots of different factors, such as scope vulnerable assets that may have no choice but to go out of circulation if there are restraints at the major carrier. You know, certainly when you look at low fuel environments, low oil price environments, turboprops generally, you know, we've seen those fall by the wayside. And, you know, considering all things aside, you know, we're already starting to see that market being quite soft. And then when you add the Flybe situation on top of that, you know, it adds on to extra softness into that market. Anyway, looking at the E-jets specifically, you know, we have seen situations where airlines have been trying to get out of them because of the relatively high cost of configuration for the asset. So we have seen some problems for that, and that was, you know, a case in point for Flybe. And we will see some of those other areas of the world. But moving from, say, the 190s down to the 175s may well be something more of a reality, to use more that asset more effectively. So certainly we could see a slight shift away from the upper size of some of those regional jets down to the smaller ones. In a similar way, we could see a very strong performance of the A220 away from the sort of the 319. So we could see how that aircraft really does start to play into it. Or admittedly though, all these will be done at lower levels of rentals. You know, the whole baseline will be shifted, and similarly for market values too. So in terms of those ones who do have availability, and we certainly will see that from the lessors who have availability, there will be quite a lot of renegotiation, I would suspect, over the next coming months. I don't know if Mike has anything to add.
I think just following on from what you said there, Stu, we had seen some sort of softening in lease rates of some of those regional jet types in the E-jet family. You know, we had seen 190 rates come down, and we had seen some, you know, some softening of market values as well, in terms of, you know, some part outs of some sort of midlife aircraft as well. We have seen some aircraft coming out into the market already, as you said, Flybe, American again getting out of a number of aircraft types, and E-jets affected there. So I mean, obviously there is a replacement phase coming through with aircraft like the A220. You know, we have to watch carefully how any sort of deferrals work into that equation. You know, some aircraft that would be replacing E-jets, you know, what pace at which we see that replacement over the next year or two will obviously have an impact on how the existing fleet behaves in terms of values and lease rates as well.
Yeah, I mean, I think the big dilemma, and I don't even know the answer myself, because, you know, we're getting quite a few questions on, you know, how we think it will play out with, you know, passenger demand once we become unlocked, in terms of will that middle seat be used? I mean, we've seen EasyJet say that they won't be selling the middle seat. We've seen Ryanair saying, well, we have to sell the middle seat. That's all part of the business modelling. But I think really that anticipation of, you know, will we all be willing to pay more for more space is really something I'm not sure I've got the answer to. You know, clearly governments having to step in to support economies, businesses. Many people have been severely affected, and we know that a lot of the GDP that drives air traffic, a lot of that demand comes from the middle classes, and how drastically affected the middle classes will be in terms of, you know, will we be down to 1 holiday a year instead of 3? I don't speak from personal experience there, by the way, but I think how will the whole world be looking towards leisure travel, and then of course business travel? Here we are on webinars, which fingers crossed appear to be going quite smoothly around the world, using various different techniques of MS Teams and Zoom and GoToWebinars, etc. So I think we're all becoming quite capable of operating businesses without flying around the world to the conferences. So I don't know if I've got the answers myself, but could this impact some of the high density aircraft? I mean, and long route aircraft like A321XLR. Have you got any views on those, Stu? I mean, I know in the vulnerable aircraft category, we did talk about higher capacity family members, but there's definitely been a move towards, you know, the long haul, low cost using, narrow bodies. But I just wonder if that's under threat. Have you got any views on that, Stu?
Yeah, I would say that, you know, in terms of the ones I put up there for the vulnerability list, I was particularly looking at more the effects of, you know, the leaner operation side of things, as opposed to blanking out the middle seat. Now, I think in terms of my own views on the middle seat aspect, realistically, you have to have separate rows between passengers. You know, if you're looking at the spread and what the studies have shown, certainly having an empty middle seat isn't really going to make that much of a difference in comparison to having blank seats. Then you start thinking, okay, I need to have 16 seats of degrees of freedom. So in terms of what, I don't think anyone's really done any proper analysis that, apart from just sort of sound bites, in terms of what really that has an effect. We all want more space, though. You know, the one thing we all do crave is clearly more space, and there will be a more desire for our own personal benefit when we're traveling to always want more space. But then what we've seen countless times before, pricing always wins. And the people will, I think, stay away from traveling, and many of the people will stay away from traveling anyway, one, from economic reasons, and two, because they're taking stock of their lives and changing how they look at their holidays. And I don't really know who does 3 holidays. It certainly doesn't fall into my category either. But I would say that people will take stock of their conditions, their lives anyway, and look very differently at how they travel, both for business and for pleasure. In terms of whether we would see maybe a resurgence for higher capacity aircraft, which allows you to have more blanked out seats or blanked out rows, economically it doesn't really, you know, it doesn't work particularly well without then looking at it, configuring the aircraft in a completely different way. And I think that it does beg the question, is there a business model out there which can now do that? I think really that the A321 LRs and those types of aircraft have a real benefit to be able to attack the wide body space anyway, just to get better operating costs and a leaner machine for that anyway. But I also think as well that the technology, the way that we're moving forward, and not for aircraft specifically, but for face mask design and better circulation systems and all those types of things, all start to accelerate as well. And I think that once, you know, the shocks start to get through people's systems and other things start to come through, we will start to see different ways and different habits in how we travel. And it will undoubtedly lead to better technologies and other aspects of design that we see in everyday life. So that will feed into aircraft too, but it will just be a pretty bumpy intermediate time.
Yeah, and I think until the airlines and, you know, even governments and regulators agree on, you know, a face mask's really useful, or they, you know, just a sign that something's happening. I mean, I see that JetBlue, I think JetBlue announced that everyone apart from very young children would have to wear a face mask from May the 4th or something. American have got a similar policy, I think. So, but I think even airports, you know, in terms of the social distancing, I don't think there's anybody come out with a real policy yet about how it's all going to work. I suppose really, I was really talking about this because a couple of the questions we've had have been around, you know, could we see an opportunity where, although we're saying an aircraft like an A380 is really one of the most difficult assets, I suppose the inference was if you could still have 250, 300 people in an A380 and you would have a reasonable space around you. I suppose to answer that question, the issue just comes down to economics, because you'll be paying twice the price. So instead of going from London to Dubai in economy and paying, I know a £600 or £700 round trip, you'll be paying more like 2,000. So that's the big question: is there the demand for that type of offering? But we have done an hour here. We haven't answered all of the questions, but some of them do drift off into some sort of things like lease negotiations and Cape Town treaty implications, which I think we will be answering all of these questions to everyone that's asked questions. We will be getting back to you, but I think I'd just like to go on to the final sort of exit side of this, really. Thanks to all of the speakers here, Stu, David and Mike. Just to say that we are using data from our online data intelligence platform, IBA IQ. We are offering free trials, so drop us a line or register through the website if you want to take a look at the system. And do get in touch with us. We've got lots of questions to answer in any case, but we are in that unprecedented situation, so we're happy to answer the unprecedented number of questions. Thanks for you all for attending today's session. You'll receive a follow-up email tomorrow and a link of recording of today's session and the slide deck. So once again, that will be tomorrow. So on behalf of IBA, Mike, Stu, David and myself, thanks for joining us today, and goodbye.